everyone, Mr. Tweet here. So in this video, I'm going to be going over the money market graph with you, specifically the demand for money. Now, in our money market graph, this is really like a supply and demand graph from Unit 2. The only difference is that like when we think of like the price of money, you got to remember that that's the nominal interest rate. And the key word here is interest. That the price of money, whether you want to, like if you want to get some money, so you want to, like, you're going to be like a consumer who's going to consume some money that you don't have. That means that basically you're going to go get a loan, right? And the price that you pay when you get a loan is the interest that you pay on that loan. At the same time, the people who supply money to other people, like you can think of like banks as being the biggest supplier of money to people who don't have it and want it. Again, the reason why they supply that money is because of the interest that they're going to earn. That's the price that they charge when they supply you with money. So my y-axis here, nominal interest rate, because interest is like when you go to get money, interest is what you have to pay to get it. And when you give money, interest is the price that you charge for the people who are getting your money. My x-axis here is just quantity, like Unit 2 quantity. The only difference is sometimes you see it as MQ or QM or Q sub M. It depends on the professor, but that really is just quantity of money. And then we've got DM or MD or D sub M for the demand for money. Now, when we talk about the demand for money, it's really important that you understand what we're really talking about is the demand for M1 compared to other forms of money, like CDs or bonds or things like that. So that, if you had $10,000 and you're trying to decide what you want to do with it, that might be a question of, well, do I want to take that $10,000? Do I want it in M1 or do I want it in something that's going to earn me a little bit of interest, what we call an interest earning asset? So that it's not like, do you want money? That's not what we're asking here on this graph, right? The demand for money is not like, hey, do you want money? Because then the answer is obviously like, yeah, I want money. On this graph, the question is like your money that you have, do you want to be able to spend it or do you want to make some interest off of it? That's the key question here. That's the choice, that's the trade-off, right? So the trade-off that we see here is that when interest rates are high, like up here, right? When interest rates are really high, then I'm not going to want my money in M1. I'm going to want to earn interest off of it. I'm going to want to put it in like a CD or a bond or a bank savings account that if like the interest rate was 50%, right? So that like I could put my money in a bank today. I put $10,000 in today, and then in a year they give me $15,000, right? Well, I'm going to scrounge up every cent I can. If the interest rate was 50%, I'm going to scrounge up every cent I can to put into that bank for a year because I want to earn that interest. So that when interest rates are high, I don't want M1, I want interest earning assets. I want stuff that's going to collect the interest so that I can make even more money in the future. Whereas when interest rates are really low, like 0.5%, like they are right now, lots of people are like, why should I even bother putting my money into like a CD or a bond or a savings account because it's not going to pay me very much interest. If I'm not going to be earning interest, why should I risk my money by letting you use it? Why not just I use it? So that when interest rates are really low, we tend to see the demand for money, right? That people want to have lots of M1. Whereas when interest rates are really high, people don't want to have a high quantity of M1. They want to put it in interest earning assets. So that's the key trade-off to understand, is the trade-off between M1 and other forms of money like bonds or CDs, things that you can't spend but give you interest. That's the key idea here. So that demand is downward sloping. Now we do have some demand shifters. You only need to worry about those demand shifters if you get a specific question about the money market graph and they ask you, how would blank affect the demand for money? Then you would need to worry about it. So like inflation or like increasing income, those things increase the demand for money. But all the time in macroeconomics, we see inflation on our graphs, or we see income going up, GDP going up, which is the flip side of income. So we could see GDP going up or income going up. We could see inflation going up. We're not going to worry about what that does to the money market unless we get a specific question that's like, hey, income is going up. How would this affect the demand for money? Then we would say, oh, well, that's going to increase the demand for money, cause it to shift to the right. And then there's a really kind of weird, shifter with this one, which is how easy is it to convert M1 to M2? And the easier it gets to convert M2 to M1, the less people want M1, the more they want M2. Because if I can collect interest on my money and I can easily spend it, that's better than just easily spending it. So the easier it gets to convert M2 to M1, the less people really want M1. But again, demand doesn't shift very frequently on this model. It's really supply that's important, and I'm going to get into that in a minute. So I'll see you guys in the next video.